Welcome to the CIO Chair, a podcast hosted by the CIO Investment Club in collaboration with the Pension Insurance Corporation. In each episode, we will sit down with top chief investment officers to explore their unique investment philosophies, decision-making processes, leadership strategies, and personal career journeys. Now let's get started. Welcome everyone to the CIO Chair, hosted by me, Sean Thompson.
And me, Hartej Singh.
The CIO Chair's first ever guest today is Simon Pilcher, CEO of the wholly owned investment management subsidiary of the university's superannuation scheme, USS Investment Management Limited. Simon joined them in October 2019 to lead the team who managed the assets of USS for both DB and DC sections of the scheme, investing across both public and private markets. The majority of the scheme's investments are managed in-house, and USSIM has responsibility for selecting and overseeing third-party managers where these are used. Simon started his career in asset management in 1987 at Morgan Grenfell before moving to Prudential in 1998, a year before it acquired M&G Investments. At M&G Prudential, he led the fixed income and alternatives businesses for 2 decades before being asked to become chairman of real estate with a combined team of over 500 employees and around £160 billion worth of assets. Welcome to the CIO Chair, Simon. I hope you're sitting comfortably.
I am, thank you, and great to be with you.
Hartej, over to you.
Fantastic. So Simon, thanks again. We're really excited about this conversation. So to kick off, what's your title and what does that look like day to day? What does your role look like day to day?
So I'm the Chief Executive of USS Investment Management. We're a wholly owned subsidiary, as Sean said. We're FCA regulated, and because we're regulated, the rest of the pension scheme doesn't have to be. So I have the fun of carrying the can in front of the FCA. The reality is I'm an investor. We've got one client, we've got one shareholder, and that shareholder is the client. So my job really is about looking after the team that's delivering investment advice and investment management to the pension fund. We're unusual in that we do both of those things. We're the principal investment advisor as well as the principal investment manager. And so I guess my job is people, investment, long-term strategy, engaging with the client and keeping the show on the road, making sure that we're a well-run and appropriately managed business that will keep the FCA happy as well as our members.
Tell us about how you got to where you are today. So obviously you are now, as you say, CEO. So what's the journey been like for you getting to where you are in your role at USS Investment Management?
I came straight into investment management after university. That was a great place to start. I joined at the time when equities were the only thing that one would consider investing in, and I got put into the fixed income team, which initially felt like a bit of a dead-end place to be, but perhaps it says something about me. I found it and still find it strangely fascinating, and I've loved that aspect of it. So 6 years initially with Morgan Grenfell Asset Management, which was latterly subsumed into Deutsche, running fixed income teams there. I took a couple of years out of investment management, then decided to come back 2 years after that. Morgan Grenfell was stupid enough to employ me again. Shortly after my second anniversary back, actually it was third anniversary back, the Pru came and were looking for a head of fixed income. So I went there as a 32-year-old and had a largely very enjoyable time at M&G/Pru, 20 odd years there. And all good things come to an end. And as one door was closing, this one opened 6.5 years ago. So yeah, thrilled to be at USS. And I'd say I've had an awful lot of luck along the way.
Could you tell us a little bit more about that? Were there any lucky breaks or intentional risks you took that might have changed the direction of your journey?
I think there's an awful lot of luck. I thought it was extraordinary that the Pru, who at the time were the largest fixed income investor in the UK, were willing to take a punt on a very young and inexperienced person, age 32, running a team, the largest team in the UK at the time. So you'd have to say that that was a lucky break. I think even more lucky than that, for most of my career, fixed income has been a rallying asset. It's just the last 5 or 6 years when that has not been the case. And you might say I got lucky again by moving into a much grander, bigger multi-asset role at that time. So all sorts of luck. I think, again, it's who you work with, who you work for. And I've had wonderful bosses for most of my career. There's been the odd moment along the way when things have been less brilliant. But for instance, I had one boss for 17 years at ING/Prudential, and I think that tells you that I've been very fortunate.
Sounds like a lucky break that I once had, actually, when I first started up in the city. I came up, was dropped off by Aldgate Tube Station. I went across to accountancy personnel and offered them my CV. They happened to say that there was a job interview that morning that someone couldn't make. Would you like to take their place? It's for Lloyds. I went there thinking it was Lloyds Bank. It ended up being Lloyds of London. And by the end of the day, I'd been offered the job and suddenly went home and told the parents that I went up to London in the morning and came back home with a job. That was my luckiest break, I think. So amazing, really. But thank you for sharing that. So tell us, looking at what you do at USS Investment Management, what is the investment mandate and who are you serving? Who do you look after and how does that look and what does that look like?
So I serve 577,000 members. We exist for them. And our task is to ensure that they have a secure financial future along with their family. That's why we exist. That's what we're here to do. Those members come from across the university sector. Many of them will be academics, but they may well be administrators, etc. The task ultimately is to pay those pensions. That is why we're here. And that is our really solemn task. And those liabilities stretch probably 80 years into the future if you think of the youngest member and how long they might live. So we invest for the long term, and we want to do so in such a way that we can not only pay those pensions, but also do it in such a way that the scheme is affordable and can be kept running for as long as possible. If we invest well, then that will ensure that the costs of those paying into the scheme, which are a combination of our employers and our members, the costs of doing that will be less expensive than they otherwise would be. And that, again, will keep it affordable and will make the whole scheme for the long term.
That's a lot of members, right? 575,000, you said?
Something like that. Yeah, a lot of members, a lot of money. £77 billion last time I checked. So it's the largest private pension plan in the UK. It's been going 50 years. This is our 50th anniversary year of the scheme commencing. And it's been, I would say, both a blessing, but also a cause of angst within the sector, because rightly, our members really value their pension. We're very, very unusual in being an open defined benefit scheme in the main. We're actually a hybrid scheme. So if you're a higher paid person, then you'll have a mixture of DB and defined contribution. So we can invest for the long term because we're there for the long term. We can invest for the long term because we've got very strong sponsors standing behind us. We've got about 350 different employers who use the scheme, and they stand alongside one another. It's a last man standing or last institution standing scheme, which means that if one of them goes to the wall, then the others will stand behind their members, the members who were employed by that institution that's now no longer there. And because we've got a strong sponsor, therefore we can invest in a lot of growth assets, and that itself will reduce the cost of running the scheme over time.
I guess, does the fact that it's an open plan change your risk appetite? And could you give us a sense of which asset classes you do invest in?
Yes, with strong sponsor, that helps. Being an open plan, that helps. The fact that we're happily in surplus now, although we weren't in surplus at all, we were in a deficit 5 years ago. But we invest in a whole variety of things. First, we hedge some of the interest rate and inflation aspects of our liabilities. So we invest in government bonds, particularly inflation-linked government bonds, because our liabilities are inflation-linked. But we only hedge a portion of that risk. We then invest in corporate bonds. Over time, corporate bonds tend to deliver better returns for not much more risk than government bonds. We own a lot of equities, both public equities and private equities. We invest in real estate. I guess the thing that we're perhaps best known for is having a very significant investment in private assets in general. So around a third of the DB section is private assets. About a quarter of our DC section is in private assets. And that's a mixture of private equity, infrastructure, private credit, real estate. So a huge variety of different things.
And that sounds that it's quite a large percentage in private markets, what you might typically find elsewhere. Is that right, Simon?
It's a much higher proportion. And we're able to do that because as a DB scheme, we have confidence that the assets will remain there. People can't just withdraw and take their money away. So we've got the benefit of time, and we therefore don't need everything to be liquid. We have the ability to do it again because we think that it'll deliver stronger returns and more diversification that will come from it. So we think it's in our members' interests. And then perhaps worth saying, we do a lot of it in-house. So we've built up the capability over a 20-year period. And obviously we haven't got to where we are super quick, but we've built the skills, the capability, the governance, and thus we're able to do it a lot cheaper than if we were using exclusively third-party fund managers, A, who are making a profit, and B, who are paying themselves handsome performance fees. I hope they would be if they were delivering good returns. And that's a very expensive way of investing in private markets if you're paying full fat fees on the sort of £26 billion that we've got in private markets.
And I suspect that because you've got the infrastructure, you've got the experience and the knowledge within the team, then obviously managing some of that in-house makes sense.
Well, it's not only cheaper, but actually we're able to source assets that meet the particular needs of our scheme. So we're a UK scheme with long-dated UK liabilities that are linked to inflation. So if I can source assets that will deliver inflation-linked returns, UK inflation-linked returns, and get higher returns than are available in the public markets, and it's very hard to get inflation-linked returns in the public markets, then we can deliver both better returns for very acceptable levels of risk that are simply not available in the public markets and that are tailored to the particular needs of our scheme. So we're not just any old scheme with USS scheme with the peculiarities of our liabilities. And we tailoring those assets within the private markets when you really know what you need is best done in-house, as long as you've got the capabilities and the scale to be able to do that effectively and efficiently.
When you're putting together the portfolio, how do you think about your benchmark, or do you have a benchmark?
We used to have a benchmark, but we concluded that if that benchmark was ever a good expression of the risk appetite of the scheme, it might have been at one time, but quickly you lose sight of what the ultimate goals of the scheme are because you tend to fixate on the benchmark. At best, it can only ever have been an approximation of our needs. But we found ourselves in a situation whereby we were outperforming the benchmark, but an enormous deficit had resulted. So you have to conclude that something has got lost in translation. And so 3.5 years ago, we adopted a completely different way of assessing performance, and actually more than that, agreeing what we should be seeking to do. And we adopted an investment balanced scorecard that looks at a range of things and gets us to think about, well, what is the ultimate need of the scheme? And the ultimate need of the scheme is to pay pensions and to do so affordably and to do so in a way that over time keeps you within the risk capacity of the sector and the risk appetite of the scheme. And so that then needs to get hardwired into some of the things that you're looking at. So individual mandates may well have a benchmark, but a lot of our mandates are more complicated than that. So, for instance, the LDI mandate, it's very hard to encapsulate that in a benchmark given the challenges associated with what we're doing. And we need to assess our performance within that bit rather than more balanced scorecard way. But if we're looking at the totality in the long term, how are we doing relative to the net present value of the liabilities? But clearly in the short term, that will simply tell you that equities have gone up, bond markets have gone down. If you hadn't outperformed that, you must be some form of fool. How do we assess you relative to that? So that's where we then need to start looking at a suite of other things.
And I guess Given that there was a change in benchmark, how did that change your thoughts about diversification? And when I think about that, obviously the future is very uncertain. And so how do you think about constructing a portfolio that might perform in an uncertain future?
Well, Hartej, I think you've really hit upon the challenge, which is that we don't know the future. We might have some inclinations about some things that might be happening, but very few of us predicted the pandemic. Even fewer of us predicted Russia's invasion of Ukraine and the inflation pulse that came through with that. And show me the person who predicted all of that. I expect we'd be looking at a very rich person. Either that or someone with a very faulty memory. I suspect the latter. So what we spend a lot of time doing is thinking about how might the future look, because the future is typically very different from the past, or at best the past rhymes into the future and the future will look different from the past. So simply looking at historic risk and return, correlations and things like that, I think only gets you so far and often can lead you to a place where you're gaining false confidence that you've got a robust portfolio because it might have survived past crises, but it won't necessarily survive the future. So we spend a lot of time thinking about future scenarios and then trying to devise a portfolio that will deliver good returns through most of those scenarios and survive practically all of them. And I say practically all of them because there is a future that we won't survive, and it's called nuclear war, and our pension fund won't survive that. But then I won't survive it, and nor will you. So no one will be there to call me to account. So we try and deal with plausible future scenarios as well as quite unlikely ones, and construct a portfolio that we think will survive and thrive in most scenarios.
And within that, how does responsible investing play a part within those decisions that you're making and the allocations that you're driving through the portfolios?
So that we spend a lot of time thinking about RI, not because we want to look good to anyone, but ultimately because it is a massive financial factor. So one of the biggest risks on a multi-decade view, I would say the largest risk that we face is global temperatures. And our conviction is that a hot world will be a world that will deliver very disappointing returns across almost all financial assets. If you think about hot world, it's likely to result in enormous changes in where things grow, in where the rain falls, in where people can live. It's likely to give rise to mass migration, failed states, wars. It's going to give rise to enormous costs to those areas of the world that perhaps don't suffer so much from it as they try to keep out the millions of people who want to move into those because where their home is has become unlivable. So if we think about that, we as a scheme believe that to be an enormous risk to our scheme. And therefore we think about, well, what could happen? How could we seek to influence that? And a few years back, we said, well, let's try and make our scheme lower carbon in terms of the carbon intensity of the assets that we own. And we set a 2050 target to be net carbon zero. We set some interim targets. But here we are 5 years on, and the carbon intensity of our portfolio has dramatically fallen, roughly 50%. We're well ahead of the track that we set for ourselves. But the sad reality is that the world has not decarbonised one iota. And so that's caused us to rethink this and say, how can we influence the actual real world outcome? I don't think by divesting a little bit from oil or a little bit from this or that, that's going to change the real world at all. But what we do have is we have a voice. We're the UK's largest pension. Government wants our money to invest in all sorts of exciting things that they'd love to see invested in the UK. That means we get to talk to decision makers and policy makers. We can express to them our longer term concerns and ask them to think about multi-decade thinking and not just this parliamentary re-election cycle. We get to talk to regulators or encourage government to think about how regulators can incentivize sane behavior, because the real world will decarbonize when it's either economically rational for consumers and corporates to do so, and if it costs them a fortune, they won't do it, and they'll do it when it's easy rather than being mired in regulatory tape when you want to move towards a low carbon future. So make it easy for people to do it and make it financially more sensible. And then how can we encourage other pension funds, other insurers, other sovereign wealth funds to think the same? Well, I go and talk like this to them. I can influence the UK government a little bit, I think. Pretty minimal impact on the Dutch government, but I know some friends in Holland who've got the ability to talk to them, and in Denmark and in Canada, etc. So we try to talk to other long-term asset owners to encourage them to talk to the decision makers, and the most important decision makers are government, civil service, and politicians, together with regulators, about this long-term issue. Now, there are other things we look at from an RI perspective. Perhaps that gives you an idea of how we approach it and why we approach it.
Yeah, it's very interesting. I was at a Pensions for Purpose event yesterday, and they've just launched the initiative for insurers for purpose, because they're seeing that there's an opportunity now for the insurance market to really start looking at what you've been doing and what you're doing on the responsible investing side. And certainly one of the things that came about was the discussions that they need to start having, both with the regulators and government as well, to start seeing how best they can change the regulations to allow them to be able to start investing in more responsibly going forward.
Yeah, you see, I don't think there's a problem with regulation from an investment perspective. I see no issue whatsoever. For me, this is a financial factor, and very clearly that. And it's very easy for us to look at risk and return and on an individual investment, and also to say, look, in the long term, a hot world is going to be a disastrous world financially. So we should be doing all that we can do to seek to change the way in which the world is operating. And we have that discretion already. I think that's completely within our fiduciary duty to do that.
So I guess, given that you have a lot of investment expertise and you also have a broad set of assets, could you give me a sense of whether indices make sense for an investor like you?
In some areas, yes. So, for instance, when we decide we want to invest in emerging market equities, I give to my team a portfolio, a sum of money, and we say, well, look, over a 3 or 5 year view, we're going to assess your performance relative to whatever the index might be, an emerging markets equity index, because we have chosen to invest in emerging market equities, and that's what we want them to do. So that's clear, that's straightforward. But if I want to assess how we're doing at a higher level, at a bigger level than that, I think indices can become minimal use or indeed be actively unhelpful. So we want to invest a lot into growth assets, and we want to have a diversified exposure to growth assets, because I don't know what it is that's going to thrive in the future, but I suspect that it'll be different from that which has thrived in the past. That's part of the reason why I invest in private assets as well as public assets. So here's a little stat that I learned in the last couple of months. If you look at all the companies that have net earnings of $100 million or more, just 13% of those companies are publicly quoted. The vast majority of businesses that are driving the global economy are private. And so if you're simply going to benchmark yourself using public market indices, you're constraining yourself to those 13%, and you're ending up with a rather warped view of the real world. And if you simply say, well, it's risk-free to invest in the MSCI, it's only risk-free if you've defined risk-free to be the MSCI. And to my mind, that is incredibly circular and I would say woolly logic, and that's a kind way of calling it. So we invest in growth assets, strangely, because we want to deliver higher returns over time than we would by investing in fixed income assets. But we want those assets over time to thrive under most scenarios and survive all of them. And so a more diversified approach than that which you'd get from simply investing in a mainstream equity index, I think, is a sane way of investing. And thus we deliberately avoid public market indices as a way of assessing, for instance, our growth exposure as a whole. We say we need a more rounded assessment of what we're doing.
So just looking at, the diversification picture and also about how you diversify geographically, I'm sort of interested more, I suppose, about the role that you feel the UK is going to play going forward in the portfolio and what you're doing around that and how you're thinking about investing in UK.
So we do invest in the UK, and we invest in the UK quite heavily. We obviously do so in the bond market because we're buying inflation-linked UK government bonds because they deliver UK inflation, and that matches our liabilities. When we're investing in public equity markets, we tend to take a global approach, and obviously UK listed businesses are a modest proportion of that. But the reality is that UK listed businesses aren't necessarily UK businesses, and many overseas listed businesses have got large chunks of them that are exposed to the UK economy. But we invest very heavily within our private markets book within the UK. And again, it comes back to our liabilities. Our liabilities are sterling and inflation linked and long duration. And it's in the UK market that we can source assets that have got UK inflation, either explicit linkage or long-term strong correlation or correlation over the very long term. And so if I look at our private book, about 45% of what we do in privates is in the UK. And if I look at the total portfolio, it's again about 45% in the UK. But if you simply look at our listed equities, it's probably more like 4% UK listed exposure.
And are you facing any challenges in terms of would you like to invest more and you're just not seeing the opportunities?
We're always looking for good investments everywhere. We have frustrations in different places. I think it's always likely that a scheme of our size will look internationally. We need diversification, and not all good ideas come from the UK. You'll be shocked to hear. So there are frustrations here, but there are frustrations in different countries as well. We've sold things in the UK on the private side. We've bought things in the UK on the private side in the last 2 years. We had a great long investment in Heathrow. We sold that, but we've made fresh investments, for instance, into affordable housing, into data centres, and into NHS primary healthcare buildings in the last 18 months. And so clearly there are things that we can find in the UK that we like.
That's fantastic. And are there any things that would allow you to invest more in the UK? Are there any sort of impediments, whether it's regulation, laws, or availability of capital? What would help sort of not just yourselves, but the broader UK pot of money to deploy more into the UK?
So pension funds don't have big capital regulations that an insurance company would have. We're not constrained in that way. Part of the challenge in the UK is getting quicker action to deliver infrastructure investments that are investable. It requires regulators to cooperate, for them to be given effectively the green light from central government for them to act. Planning, government has made some great noise about planning. We are utterly and totally supportive of that. I've been encouraging them in speeding up planning. But people need to understand that all sorts of things need to come together for investment to happen. And one of the most important things is about seeing long-term joined up thinking. And I would say that that is an area which the UK has had room for improvement. Again, new administration is making good noise in that area, but it requires consistent execution. And again, I think that there is just a challenge amongst in the infrastructure arena for that to happen, because these things take 10 years to build, and you need to have security over a multi-decade view if you're going to make large-scale investments in that area.
Do you think collaboration amongst pension schemes and indeed insurers now, do you think there's not enough of it? Do you think you would like to see more of it?
Oh, it's going to grow. So we've been one of the few pension funds that's been actively investing in private assets in the UK for a long time. There's clearly a big impetus from government, but also from within the new DC schemes, for instance, to do that. It's taken us 20 years to learn how to do it in the way in which we do it. You can't do what we do overnight. So we've got scale and have got experience. I'm not allowed to manage money for other people. I'm not here to pitch for mandates. I can't do it. But we're very keen to aid and abet and help others. And yeah, more competition for assets amongst asset owners in the UK would be great. We'd be really supportive of that.
Excellent, thank you. So I'm going to change this subject slightly now, and I'm just wondering if we sort of looked at lessons learned or things that have happened in the past. I'm just wondering whether or not you could share maybe perhaps a pivotal learning moment in your career that had a lasting impact on how you lead today and how you work within USS Investment Management.
I look back with shame on one event many years ago. The culture within which we operate as investors, I think, is all important. And culture that ultimately depends on trust. Successful fund management operations are one whereby people collaborate and they cooperate and they work together for the long term for their clients. So, as a chief executive or a chief investment officer, we're the ones who ultimately have the biggest impact on defining that culture and on seeking to inculcate it. I would think 20 years ago, as I was looking to upgrade one particular desk and to bring in someone from outside, which I think was the right thing to do. I have no regrets about that action, but I was not truthful in speaking with one colleague who would have been impacted by that. Now, I don't think it's wise to go and tell everyone 6 months ahead of what you're going to do that you're going to make a post redundant. That's not wise. But when you're asked a straight question and you deliver an answer that was, in my case, untruthful, that's corrosive to trust. And I still deeply regret my lack of truthfulness on that occasion, because it corrodes the culture, which again, I think is critical to success.
Thank you for sharing that. That's very honest of you, and obviously has affected you quite a lot over the years as well. Just wondering, over time, how has your investment style evolved? And I suppose involved not just for you as an individual, but also how the firm's investment style has perhaps evolved over the time that you've been with them.
Gosh, I mean, if you take me back to the beginning, I knew, well, even less than I know now. And I think the longer I go on, the more I realize I don't know. I've spent a lot of my career thinking that markets exhibit greater volatility than they should do, as data changes, markets tend to overreact. And so being an investor that is willing to take the counter-cyclical position when markets are exhibiting great volatility has long been my view, though doing that in ways whereby you're not going to get stopped out, as in your career comes to an end before your investment call comes to an end, is a wise way of doing that. I've seen that happen with businesses who have basically bet everything on a particular event happening. And that event is going to happen when that business is basically closed down or the chief executive of that business loses his job. We've seen that happen on several occasions. The big change that I've been learning and that we have adopted here is more of a total portfolio approach. So think about the totality of what you've got and how different elements of your investment portfolio combine to create elements that can either bring protection that other aspects of your portfolio need protecting from, or can deliver returns when the rest of your portfolio is perhaps going to be a bit meh. And so how can we sculpt a total portfolio that is not driven by strategic asset allocation, but is looking more deeply inside the different investments and how they knit together? And that requires a lot of collaboration, cooperation, and an ability to see things at a bigger level than your typical fixed income credit person, which is what I am by background, who loves to overanalyze minute areas of detail. So to see the big picture. And that's how we've been thinking about our total portfolio construction. It's hard to communicate what we're doing. That is the big challenge.
That's a question. So is there anything that you would invest in more of that, let's say, if you took a typical SAA approach, you would invest less in?
It sort of comes back to definitions. So in my experience, assets that sit at the intersection between different asset classes get either overpriced or underpriced. And let me give you an example. I might own real estate that's got a very long lease to a high quality tenant that's contracted to pay an inflation linked increase on those leases. Legally, it's real estate. The reality is it will behave like a long-dated inflation-linked corporate bond. And I might therefore conclude that I'm going to massively overweight real estate by buying those types of instruments. And that might look very odd on an SAA, but the reality is its characteristics are very different from whatever it is you think of as normal real estate. And so you need to look inside what you're buying and ask the question, what is it? And what's it going to deliver to me? And how does that meet my needs? Again, our needs are long-dated UK inflation. So if we can source some of those types of assets, then we might end up with an odd-looking portfolio from a top-down perspective. But if you look at it from within, it makes sense.
So how do you, okay, just going on from that and from the previous conversation, how do you ensure the firm's values and culture align with the way in which you invest your monies and the decisions that you're making when investing your portfolios?
So I've talked about a total portfolio approach and that requiring considerable collaboration and cooperation. Well, if I'm then the one who's going to call all the shots, that is kind of antithetical to that espoused desire to get that total portfolio approach coming through. And so one of the things that we have very consciously, deliberately sought to inculcate is the idea that I don't take all the decisions. And I've got some very, very highly talented and capable people who work with me. And we, or they, are going to be the ones who are running much of that decision-making responsibility. And together, we need to grow the business and take the investment thinking forward. So you've got to devolve power if you think that is what is going to lead to better investment decisions. And you've got to be delighted when your colleagues are seen to have done an outstanding job and bask in their reflected glory rather than hog the limelight for yourself as a sort of another flip side of that. People like working in that type of environment. I mean, we might have had bosses who like to steal the glory that perhaps we deserve. Well, empower people. If you've got capable people, train them, educate them, and give them the confidence and the necessary rope to go off and do things whilst understanding holistically what's going on. So don't lose sight of what's going on, but understand it.
When you're fashioning a team, are there any qualities that you look for either in recruitment or in bringing people together that other investors might overlook?
From some of the things I've said, can I trust this person and will they tell me the truth? Or are they going to be like me 20 years ago in that instance? Because over my 20, however many years it is, of being in a fairly senior position, I think I've probably said goodbye to more people for cultural reasons than for investment in competence. If people are wedded to the idea that it's all about them and they refuse to collaborate with others or actively despise others, then they are kind of poison to the DNA of the organization that I think you need if you're to succeed in this game. And so, yes, clearly, therefore, part of the recruitment process needs to be thinking about that aspect. It's clearly we need more than that, but we don't need less than that. And then we need to talk about it. What is it that we think will make us successful? And how can we create the conditions? How can we bring in the right people? How can we preserve what we've got if what we've got is good? How can we improve what we've got if it needs improving?
So one of the purposes, aims of this, the CIO Chair podcast, is obviously to allow younger investment professionals the opportunity to learn from the CEOs and the CIOs of asset owners and investment managers. So what advice would you give to someone that's perhaps early in their investment career, and maybe even someone who's later in their investment career, but what sort of sound advice would you give them?
I'm always humbled by how little I know, and by how little I know, especially about the future. And I would say keep learning, keep looking to learn, and especially when things are going well, keep humble. In my experience, we need to have some of the ego bashed out of us when things are going well because we become overconfident. And when things are going less well investment wise, if you're a portfolio manager, the job of a senior is to encourage and support and empathize. So I guess don't despair if you're going through a rough patch investment-wise. Stick to your convictions, your investment philosophy and your process, and keep working.
And I always say, don't forget to ask, because everyone's there to be able to help you, to answer the questions that you might have, to guide you. So no, I totally agree.
And I guess outside of the investment arena, how do you keep grounded so that you can sort of be your best self when you do come to the office?
I'm a very fortunate man. I've got a fabulous wife and I have got wonderful children, all of whom are astonished that I'm remotely competent outside of the home, given how incompetent I am within the home. I think spending time with them is great. Look, I'm heavily involved in my church. One of the things that teaches you, reminds us, is that we're all failures. We're people who fail. We say sorry. We try to change. But once you acknowledge that you're not a superhero, which Christians are not, nobody is, then that again, I find helps me get through the good times. Get your ego out of the room, Simon. I guess I'm also just very lucky in that I can compartmentalize. So I'm able to just leave the stressful things at work and grow my vegetables in my garden.
We'll make sure that your wife and children get to hear the last bit of this podcast so that they can hear the applause that you gave them. But that's lovely. That's absolutely lovely. So coming near to the end, just wondering whether or not you'd like to sort of think about what would you actually like your legacy as a CIO to look like at USS Investment Management?
Well, the first and most obvious thing is that we keep paying the pensions as they fall due and that the scheme is in good health and the costs of running it in terms of contribution rates are modest. But the way that'll happen is if we've got a great team and that team is acting as a team and is able to take off and thrive even further. So that really is your legacy. The legacy is the condition that you leave the firm. The condition you leave the firm in is about the people and obviously about it having delivered to our members. Ultimately, that's who we're here to serve. This is not my career. This is not my team. It's our members. It's their money, and we're here to serve them.
Absolutely fantastic. Simon, thank you so much. It's been an absolute pleasure talking with you today. I'm going to do last quick fire, 4 questions. You haven't rehearsed this. We haven't rehearsed this. Favorite drink?
A very, very, very strong coffee first thing in the morning. Only one, but very strong.
Excellent. Best film that you've ever seen?
Oh, I'm not really a film person, but I thought that the Martin Luther King Road to Selma made a big impression on me. Yeah.
Worth it. Preferred sport?
Oh, cricket. Any form, any place, anywhere. Men, women, T20.
You like your cricket. And the last book you read?
Oh, I'm rereading Dick Francis. It's delightful nonsense that gets me through the commute and doesn't tax us the brain. I can't even remember which book it was I finished yesterday.
Excellent. Simon, thank you so much. Hartej, thank you for joining, for all being here. It's been an absolutely fabulous first podcast episode of the CIO Chair, and we look forward to doing another one soon.